Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Victory Shares and Solutions, which sponsors a number of volatility-weighted and thematic ETFs, has recently launched an active equity ETF, the Victory Shares WestEnd U.S. Sector ETF, ticker MODL, based on a popular SMA and UMA model strategy from WestEnd Advisors, a Victory Capital investment franchise. Here with me today, we have Ned Durden. He's the Chief Investment Strategist at WestEnd. Ned, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me, Jill.
All right, you got it. And so MODL, it's an actively managed ETF of ETFs. That seems pretty unique, but managing active portfolios of ETFs is nothing new to you. Tell us about WestEnd's experience.
Sure, that's right, Jill. MODL is actually based on our U.S. sector strategy, which we launched just about a decade ago. And in fact, we've been employing our top-down macroeconomic-driven investment approach for over 25 years. We actually began to implement that approach using ETFs in 2005, and that gives us one of the longest track records of managing dynamic model portfolios of ETFs in the industry.
And the strategy is focused on sector allocation and avoidance. Can you walk us through WestEnd's approach?
Certainly. So the cornerstone of our investment philosophy is that the macroeconomic environment drives markets. And our goal is to construct dynamic model portfolios that can stay aligned throughout a full economic cycle. We focus on sector allocation because we know that depending on where we are in the economic cycle, certain sectors will perform well, other sectors will perform poorly. And so we know by owning or avoiding sectors at the right time, we can create the opportunity to generate alpha for our investors. Our process begins with a very thorough overview of the macroeconomic backdrop. We follow over 200 macroeconomic data series, as well as information from leading public companies, both here in the US and around the world. And what we're trying to do with this data is paint a picture of the broader economic backdrop. We're looking for areas of economic strength and trying to avoid those areas of economic weakness. And so another way to put it is we're looking for economic tailwinds. And again, we're trying to identify and avoid economic headwinds. And we're not only looking now, obviously, but for the next 6 to 18 months, which is our investment time horizon. So then based on what we see in our outlook, we know that certain sectors will perform well in different types of economic environments. So in the early phase of an economic cycle, a dynamic growth phase, we like to own those most economically sensitive sectors. As a cycle progresses, growth begins to moderate. We still want some degree of economic sensitivity in our portfolios. So we'll own mid-phase sectors like information technology, consumer discretionary, and communication services. And then as growth begins to slow, recession on the horizon, you'll see us tilt towards traditional defensives or late phase sectors like healthcare, utilities, and consumer staples. At any one time, we'll only own 4 to 7 sectors of the S&P 500 with 0% exposure to those other sectors. And finally, we implement this strategy by buying market-leading sector ETFs.
So, Ned, would you characterize this as either a growth or a value strategy?
Neither. We would characterize it as core, but interestingly, depending on where we are in the cycle and what sectors we own, we can sometimes resemble a traditional growth manager, and other times we can resemble a traditional value manager. And we don't look at investment allocation decisions through that traditional style lens because we really believe that active sector allocation can offer a lot more opportunity to generate alpha than traditional style-based approaches. Let me give you an example. If you look at the difference between the best 5 performing sectors in any given year and the worst 5 performing sectors, that performance spread between those sectors averages about 20 percentage points per year. You compare that to growth or value, large cap or small cap, that's almost twice the performance difference out of sector selection. So to us, the bigger the performance spread between any investment category, the greater the opportunity to generate excess returns. And sectors have consistently have this high performance spread year after year.
How should investors use your U.S. sector strategy?
So we've seen investors use U.S. sector now available through MODL in a number of ways. It's often used as their single U.S. large cap allocation, often as a substitute or as an alternative to a fully passive allocation. Or sometimes investors will marry U.S. sector with a leading style-based approach or maybe a leading dividend manager. And what this allows investors to do is keep their entire investment allocation timely throughout a full economic cycle, and again, gives them the opportunity to generate more alpha.
And finally, given that your sector decisions come from your macroeconomic outlook, what are you seeing in the economy and how is that driving your market positioning?
Sure. Well, I would say overall, this is a very fast-moving cycle. Going back to the pandemic, and that started in March of 2020, we saw basically the world economy shut down in a matter of weeks. And this obviously weighed on economic activity and in economic data. We saw the biggest drawdown in payrolls that we've seen since the 1940s with the pandemic. Interestingly, it took less than 2 years to recover all those payroll gains. And actually, payrolls are much higher now than they were even before the pandemic. We saw a tremendous amount of spending on goods by consumers, especially durable goods, anything from autos to washing machines. And this was driven at first by stimulus checks, then by higher wages and excess savings. But at the same time, we saw supply shortages, either from supply chain issues or from the inability to find skilled workers. And this led to inflation, and that's led to the Fed's response, which is one of the strongest rate hiking cycles we've seen since the strongest since the 1980s. So looking ahead, we are concerned that economic growth is slowing, and it may go negative, it may not, but we do think the risk of recession is going up, especially because we really haven't seen the impact of those Fed rate hikes yet. So how are we positioned? Well, we think earnings from those most economically sensitive sectors I mentioned are the most at risk in the environment ahead. So therefore, right now, we have no exposure to those most economically sensitive sectors, no energy, materials, industrials, financials. We're overweight traditional defensives, healthcare, staples, and utilities, and we still maintain some allocation to information technology and communication services, which we think can deliver better relative performance than those early phase sectors.
All right, Ned, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.